Hey, cost segregation is one of the most powerful tax tools for real estate investors. And for a lot of you watching this video right now, it would be a huge mistake. Now, let me say that again because I've made videos showing how cost segregation saves people tens of thousands of dollars, and I stand behind every one of them. But the studies, the strategy, the pitch you're getting hammered with right now, it's not a one size fits all. And in 2026, more of you are getting that pitch than ever. And the reason why is because Congress just brought back the biggest version of this benefit we've had in years. So listen, before you write a check for a study, I want you to walk you through the situations where I, as an attorney and an investor, would tell you to pause or actually skip it entirely. All right, let's get started. Okay, so quick level setup here. What do we make sure we're talking about the same thing? You see, cost segregation or cost seg is a study usually done by engineers or a tax preparer that breaks down your building into pieces. You see, normally you depreciate residential real estate over 27 and a half years and a commercial building over 39 years. Now, depreciation just means you're deducting the cost of the building a little bit at a time. So you see what a cost segregation study does is it pulls little pieces of that building out that wear out faster, like the flooring, the fixtures and wiring, landscaping, driveways, and it lets you depreciate those over 5, 7, or 15 years instead of the 27 and a half or the 39 because they're going to wear out. Now, you're not creating new deductions here. You're just pushing them forwards. Here's what's new, though, that passed that gets everyone excited. You see, on the big, beautiful bill that came into effect last year, and it brought back permanently the 100% bonus depreciation. Now, what does bonus depreciation mean? It means you can deduct the full value of the shorter cost seg or shorter year life components of your building. So instead of spreading it out over 5 years, 7 years, or 15 years, all right, you deduct it all at once. Now, it applies to property placed in service after January 19th of 2025. So that means you bought an investment property after that period of time, then this is what would apply to you. So for a couple of years before that, between 2018 and 2025, it was on a declining schedule. So if you still bought property after 2018 or in 2018 to 2025, you still get this benefit. It just may not be at 100%. So which means every cost seg firm, every promoter, every guy on your internet feed is selling you harder than they probably have in years. And the benefit got bigger, so the pitch, as you see and I've seen on social media, has just gotten louder. And a louder pitch is exactly when you need to slow down because a bigger first year deduction only helps if you're in a position to use it. Now, let me show you 6 situations where that might not be the case that you need to be aware of before you go out there and invest in that cost segregation study. Okay, number 1, the loss has nowhere to go. Okay, number 1, and this is a big one because if the loss has nowhere to go, then it's not going to benefit you. So let's think about this. Okay, so let's talk about here Marcus. Okay, so Marcus, he's a software engineer. He's a W-2 wage earner, and he's pulling in $300K a year from his W-2. Now he goes out there because he listened to a video about the benefits of real estate and the short-term rental benefits that come from that. The tax loophole is what people refer to it as. I even refer to it as in my videos. But here's the thing. He buys this property right here. So he purchases this property and he finds out that he can do a cost segregation study on it. So a cost segregation study is done and it shows that he can generate $100,000 in first year losses, all right? So now he's thinking, wow, this is awesome. I have $100,000 in losses that I can deduct against. But here's the problem. You see, under Section 469 of the Internal Revenue Code, rental real estate is a passive activity for most people. So what passive means is that the losses only offset passive income or other rental profit. So unless that property is bringing in $100,000 a year, so I'll give you an example here. Let's say it generated $120,000 in income after taxes and depreciation expenses and some other expenses he may had. So then Marcus would be able to take this $100K right here, deduct it, and he'd only show $20,000 in income. All right, well, that makes sense in that scenario. But the problem is Marcus isn't generating $120,000 a year in income. Marcus on this property, which like a lot of real estate investors might only be generating $45,000 a year in rental income. So what ends up happening under the passive loss rules of Section 469 is that he's going to have a loss of $55,000. This is a loss. Now, what does that do for Marcus? Well, it doesn't do anything that he heard on these videos that he was watching, because that passive loss is going to be suspended. It just sits there until he has more passive income or until he sells the property. You see, Marcus didn't save $55,000 this year. You see, that is the problem. He saved nothing. I mean, the benefit's real, but it's deferred, sometimes for years. Okay, so here's the thing I want you to understand. In order to take this loss, which a lot of people don't talk about, you have to qualify for it. Okay, getting the study by itself is not sufficient. You actually have to qualify to be able to take the loss. Okay, so let's go on to number two. Now, all right, in number two, you're not in a bracket where it really matters, right? It means you're not making enough income to even make this beneficial to you. You see, a deduction is only worth your tax rate. You know, the $10,000 deduction is worth $3,700 to someone who's in a 37% tax bracket, and about $1,200 to someone who's in a 12% tax bracket. You see, the same deduction, but it's a very different payoff. And this is where confusion sometimes creeps into these analyses, is that you need to know what it means in real dollars back in your pocket. Okay, so all you do is you take the deduction that you think you're going to get, you multiply it by your tax rate, and that is your actual savings. I sit with people all the time that come to my events, and they talk about tax deductions, and they say, hey, I want to take this deduction here. And then I have to say, all right, slow down. What tax rate are you in? What does that mean in terms of real dollars for you? Because if you're spending more money than the deduction you're being given, that does not make sense. So let me put this in an example. So let's imagine Lisa, right? She's semi-retired. Her taxable income is really low right now, but she knows a business sale that she has is coming in 3 years that's going to put her into a top tax bracket. If Lisa front loads a giant deduction this year, she's spending it at a discount. You see, those same deductions used in a higher income year could be worth 2 to 3 times more. So here's the thing. When it comes to deductions and using a cost seg study, you want to match your deductions to your highest tax years, not just your newest property. That's one of the things that I do with my own investing. I look at my rental income, and depending on how much income I'm bringing in, I will then match the cost seg studies to wipe out that income, and I won't claim any more than I need to keep my income as low as possible. You see, sometimes the smartest move with cost seg, and this is again what no one's talking about, is to wait, okay, or to time the study to your income arc. So if your arc of your income you know is going to be going up, then that's when you want to be looking at taking advantage of that study. Or when you sell, say, SpaceX stocks and you get all this income coming in, then it might be an opportunity to do that. Okay, number 3, you're going to sell sooner than you think. All right, this is a problem where I see most expensive surprises. So let me put it on the board for you. Okay, so let's take Marcus again, going back to that example. So he has the house. And remember, he did $100,000 on a cost seg study. So that was the deduction he got in year 1. Now, going forwards, he still is depreciating the property. So let's say over the next 5 years, he receives straight line depreciation on that property of $50,000. Now, here's where the math comes into play in taxes that people are not paying attention to. You see, when you sell this property, all right, the IRS wants that depreciation back, and it's called depreciation recapture. So when he sells the home, the depreciation that he took initially, right here, the $100,000, that's going to be recaptured at his ordinary income rate. So that could be anywhere, 32, 37%. Let's say he's at 32%. So he's going to pay $32K in taxes on that, not long-term capital gains. And I've seen a lot of real estate investors make this mistake, is that they capture that deduction up front. They may be in a lower tax bracket when they took the deduction, but when they sell, they're in a higher tax bracket. So that can be problematic. Now, the $50K, that's going to be taxed at a flat 25%. So there'll be $12,500 on that. So generally speaking, you're going to pay $42,500 just in recapture taxes before we get into determining what your long-term capital gains is. So That is one of the issues that, it's not fun, but it's manageable. You see, cost seg moves a big chunk of your building into personal property. Remember I said 5, 7, or 15 years. And so when you're reselling, that's what you're eating on that resale. Now you can use 1031 exchanges, but it does get a little complicated there when you're doing a 1031 exchange for that area of the property, which is referred to as Section 1245 property, the 5, 7, or 15-year stuff that you're recapturing. So you got to be careful of that, about that. Okay, so the fourth one, this property is too small to clear the cost to justify the study. And I already hinted about this earlier. You see, a cost segregation study is not free, and depending on the property, you're often looking at spending at least a few $1,000s. Sometimes it could be a lot more based upon the value of the property. Now, what I want to do is let's look at Ryan as an example here. So in my example with Ryan, okay, he buys let's go right back here. So we got Ryan right here. So what he does is he buys a rental property just like Marcus. He buys this property for $180,000, all right? Now, a big chunk of that value in that property is the land. And so this is the other thing you have to be aware of with cost segregation if it makes sense for you. You see, land is not depreciable, all right, ever. So out of that $180,000 purchase, if $90,000 of that is related to the land, so let's say he bought this 3 acres of land, it's got a little structure on it, a single house, a 1-bedroom home, very small, and the value is really in the land. So once you strip out the land, as you can see here, there's only $90,000 left, or it could even be much more. So by the time you pay for the study and the tax savings, you're barely going to beat the fee. So that's what we need to think of when we're putting these types of deals together. Because the cheaper the property and the higher the land value, the worse the math is going to be. Now, there is always a break-even point. You need to figure that out, okay? Because once you go below it, now you're just, as I stated earlier, spending money for a study that isn't going to produce any benefit for you. Now, the fifth problem we have, and this is the stealth one that, again, a lot of people don't talk about here, okay, and that is your state doesn't follow the federal rules. You see, this is one of those bigger moments where 100% bonus depreciation came back. Everyone's screaming about, great, I'm glad it's back. But a lot of states have decoupled from the federal bonus depreciation. That means they don't recognize it. And they did this intentionally because they don't want you, if you live in a certain state, being able to reduce your state income taxes because they want to get as much as they can from you. So you can take that giant write-off on your federal return and then your state says no thanks and makes you add a lot of it back in. So if you're in a high tax state that doesn't conform, your real estate benefit is actually smaller than the headline number that promoter is showing you on that Instagram video you watched, because that number, and I've done this myself when I talk about it, typically we only talk about federal only. That doesn't mean it kills the strategy, but your actual benefit is federal minus the state add back. And you need to see that combined number before you decide. So that's always important. All right, number 6, okay, this is the one I feel most strongly about, and it's the tax benefit is the only reason the deal works. Okay, so here's the pattern. An investor runs the numbers on the property, and it's a no-go. Negative cash flow, thin margins, you name it, writing checks every month. Who would do that? But then someone drops a year one cost seg benefit on a spreadsheet for them, and they suddenly say, oh, wow, this is great. Listen, stop right there, because so many investors have been hurt when they've fallen into the trap, right? That it produces a great tax deduction. Listen, that tax deduction does not fix the problem of the property. If the property is underperforming and you're still willing to write that check every month, the deduction will never pay for your mortgage. And now you've taken on liquidity risk and the stress of carrying a loser property just because the tax adjusted return looked pretty on paper. So I would tell you, I've talked to real estate investors time and time again. When they bring deals to me, I say, listen, have you underwrote this deal, right? As if the cost seg did not exist. I never do a deal only based upon the tax side of it. In fact, I question deals when people bring them to me and they say, hey, this is your return. Well, when you're calculating that out, how much of that is the tax side? Okay, because that is important to me because I want to make sure the deal works without the tax benefit. Otherwise, you got a bad deal wrapped up in a costume. Okay, so before you actually decide, before you pay anyone for a study, run these 3 questions. This is the filter that I use. Okay, number 1, can I actually use the loss this year? Okay, that's the first thing you need to look at. Number 2, how long am I really holding the property? And 3, does the deal work without the tax benefit? Okay, 1, can I actually use a loss this year? That's your bracket and your passive status. If the answer is no, then the benefit's deferred, and that changes everything. Now, of course, if you watch my other videos about utilizing the short-term rental loophole, hey, if you're materially participating in that property, well then yes, then it could make sense for you because you're able to take that tax benefit, that deduction, and apply it against your active income. So in my first story about Marcus, if he could prove that he was materially participating and the average rental period was 7 days or less, then yeah, that could make sense for Marcus and that deduction would not be deferred. But in the example I gave you, it made 0 sense. Now on how long you're holding. The shorter the hold, the more the recapture eats the benefit because you're going to have to go back out there, right, and recapture it when you sell. And then the third one about does the deal work without the tax benefit? Listen, if it doesn't fix the deal before you touch the strategy, then you don't want to deal with this. So 3 clean yeses and a cost seg might be one of the biggest moves for you this year. Okay, a no anywhere is a stop sign. That's why I would look at this and then reanalyze what it is you're doing to make sure that it makes sense for your situation. All right, so here at Anderson, that's exactly what we do for you. And my team, okay, can definitely assist to look at your situation and tell you, hey, based upon where you're at, whether or not it makes sense for you to look at a cost segregation study. If you want to find out how to get a hold of my team, go to the show notes below. I have a link down there where you can click on that link and schedule a free strategy session where we'll look at your individual investing situation and make a honest determination with you about whether or not it pays off to do that. We'll talk about other ways to reduce your taxes and we'll talk about how to protect your investments. Hey, I've also put together a free companion to this video when cost segregation doesn't make sense. And this is what it is. It's a checklist of items, these 6 situations in a self-guide that you can run on your property. Listen, if you want to get that, grab it in the link below, run your next deal through it, and you'll know which trap applies to you before you ever get on the phone with us. Okay, I hope you liked this video. Be sure to smash that like button if you found it to be beneficial. Also, if you're not yet a subscriber, well, you know what to do. Subscribe to the channel. Take care.